The entire market is sitting on a knife's edge. We are just hours away from a huge Federal Reserve decision that could either spark a massive year end rally or slam the brakes on the market and trigger a sell off. The stakes honestly couldn't be higher. Right now, traders, investors, and algorithms are all holding their breath, waiting for one person, Fed Chair Jerome Powell, to walk up to that podium and tell us what's next. So, what's it going to be? Will the Fed give the market the rate cut it's desperately betting on, kicking off a Santa Claus rally into 2026? Or will they drop a hawkish surprise, kill the momentum cold, and remind everyone the fight against inflation isn't over? And this is about way more than a quarter point move. It's about where the market is headed for the next 6 months. In this video, I'm breaking down everything you need to know. We'll cover the exact dovish signals that could send stocks flying and the hawkish tripwires that could cause a nasty downturn. We're going to dissect the official statement, the infamous dot plot, and the little details in Powell's language. That way, when the news drops, you'll know exactly what to look for and how to read between the lines. This is your guide to the most important Fed meeting of the year. So, why is this meeting on December 10th, 2025 so important? It's because the Fed is stuck between a rock and a hard place, trying to make sense of completely contradictory economic data. This has led to a deeply divided FOMC, where officials are openly disagreeing about what to do next. On one side, you've got the dovish case, the argument for cutting rates. The labor market, which was once red hot, is definitely cooling off. Recent reports have shown some concerning weakness, like rising unemployment claims and even some job losses in the private sector. The September unemployment rate already ticked up to 4.4%, a number that's making some Fed officials pretty nervous. We've also seen consumer spending start to soften, suggesting the economy is losing steam. On top of all this, the Fed concluded the reduction phase of its quantitative tightening QT program on December 1st, a move widely seen as a step toward a looser monetary policy. The market saw these signs and ran with them. As of this morning, the CME FedWatch tool shows traders are pricing in about an 87% chance of a quarter point rate cut. That's some serious conviction. But on the other hand, there's a strong case for being hawkish and holding rates steady. Inflation is the problem that just won't go away. While it's way down from its peak, the latest CPI and PCE numbers are still hovering stubbornly above the Fed's 2% target. With annual inflation at 3% as of September, the central bank is not ready to relax. Some Fed officials, the hawks, see this sticky inflation and argue that cutting rates now would be a huge mistake. They're worried it could let inflation expectations run wild, forcing them to hike rates even more aggressively later on. This group points to parts of the economy that are still surprisingly strong and worries that it's just too early to declare victory. This deep division inside the Fed is what makes this week's meeting so unpredictable and potentially dangerous for the market. Are they more worried about a recession, or are they more worried about inflation roaring back? The market is betting big on the former, but if it turns out they're focused on the latter, we could be in for a world of pain. Before we get into the scenarios, let's quickly break down what dovish and hawkish really mean. Think of the Fed as the economy's driver. The gas pedal is dovish policy, and the brake is hawkish policy. A dovish stance is when the Fed is focused on boosting economic growth and jobs. Doves are more willing to accept a bit of inflation to make sure the economy doesn't slow down too much. Their actions are generally bullish or good for the stock market. When the Fed is dovish, they talk about cutting interest rates, which makes it cheaper for businesses and people to borrow money. This encourages spending and investment, which helps companies make more money and drives up stock prices. A dovish Fed is the market's best friend. A hawkish stance, on the other hand, is when the Fed's number one goal is fighting inflation. Hawks are willing to hit the brakes on the economy and even risk higher unemployment to get prices under control. Their actions are generally bearish or bad for the stock market. When the Fed is hawkish, they talk about raising interest rates or keeping them higher for longer. This makes borrowing more expensive, slowing down spending and investment. A hawkish Fed is usually seen as an opponent to the market, prioritizing price stability over short-term stock gains. For this week's meeting, we're not just listening for a rate cut or a hold. We're listening for the tone. The Fed could cut rates but use such cautious, hawkish language that the market sells off anyway. That's a hawkish cut, and it's a real risk. On the flip side, they could hold rates but signal so strongly that cuts are coming that the market rallies. It's all about the subtle clues, and that's what we're breaking down next. All right, let's start with the dream scenario for the market, the dovish pivot. If the Fed comes out dovish, it could ignite a face-ripping rally. Here are the 4 key things to watch for that would tell you the bulls are taking over. First, the most obvious one. The rate decision itself. The market is pricing in a 25 basis point cut, which would drop the federal funds rate to a target range of 3.50% to 3.75%. That's the bare minimum expectation. Anything less would be a letdown, so getting that cut is the first hurdle. If they deliver, it's a clear sign they're shifting their focus to the weakening job market and are officially starting to ease policy. Second, we need to tear apart the forward guidance in the FOMC statement. Every single word in this document is chosen carefully. For a truly bullish signal, you want to see language that specifically mentions the weakening economy. Look for phrases like downside risks to employment have increased or the labor market has clearly cooled. That would tell us their focus is shifting from inflation to jobs. An even bigger dovish signal would be if they drop the word restrictive when describing their policy. If they stop calling their policy restrictive, it suggests they think rates are high enough and they're ready to start cutting more. The ultimate tell, the golden phrase, would be something like, the committee expects that additional policy easing will be appropriate. That would be an open invitation for more cuts in 2026 and would send stocks soaring. Third is the summary of economic projections, SEP, specifically the dot plot. The dot plot is where each Fed member anonymously marks where they think interest rates will be in the future. It's basically the Fed's crystal ball. The market is currently hoping for about 3 rate cuts in 2026. If the median dot for 2026 lands at or below 2.75%, implying 3 or maybe even 4 cuts next year, that would be extremely bullish. It would confirm this isn't just a one-off cut, but the start of a real easing cycle. Also, watch how the dots are grouped. A tight cluster of dots at lower levels signals a strong agreement and confidence in cutting rates. Fourth, and maybe the trickiest part, will be Chair Powell's press conference. This is where tone is everything. In a dovish scenario, Powell will spend most of his time talking about the job market. He'll highlight the softening data, the risks of a sharper slowdown, and the Fed's commitment to maximum employment. He'll likely downplay recent inflation numbers, maybe calling them transitory. But here's the pro-level signal to listen for. Any hint of liquidity support. Powell won't announce new quantitative easing, QE, but he might use some dovish code. Listen for phrases like ensuring ample reserves in the banking system or a readiness to act if financial conditions tighten. Any talk like this would be seen by big money traders as a form of backdoor QE, a signal the Fed is ready to pump liquidity into the system, not just cut rates. This would be pure rocket fuel for assets like gold, bonds, and even crypto. If we get this combination, a rate cut, dovish language, a friendly dot plot, and a Powell presser focused on jobs and liquidity, the market's path of least resistance will be sharply higher. Now, for the nightmare scenario, the hawkish surprise that could pull the rug out from under this market. Since expectations are so high for a cut, a hawkish outcome would likely cause an immediate and brutal sell-off. Here are the tripwires to watch out for. The biggest shock would be the rate decision itself. If the Fed decides to hold rates in the current 3.75% to 4% range, it would completely defy the 87% odds priced in by the market. That would be a stunning move. The reason given in the statement would likely be that inflation risks remain elevated. A no-cut decision would instantly bring back the higher for longer fears and send a wave of panic across markets. The second tripwire is the forward guidance. Even if they do cut rates, they can make it a hawkish cut. This would happen if the statement is full of warnings. Look for phrases like the labor market remains resilient or inflation remains elevated. This kind of language would dismiss the soft data the market is focused on and put the spotlight back on inflation. If they keep the word restrictive to describe their policy, it's a clear signal that this cut is a one-time thing. The third and most critical hawkish signal would come from the dot plot. This is where the Fed could really crush the market's hopes for 2026. A hawkish dot plot would show the median dot for 2026 at 3.00% or 3.25%, meaning only 1 or 2 cuts next year, way below what the market wants. You'd also probably see the dots scattered all over the place, which signals a fractured committee and a lot of uncertainty. The market hates uncertainty. Finally, we have Chair Powell's press conference. A hawkish Powell would sound completely different. He'd spend his time hammering home that inflation remains too high and warning against cutting rates too soon. He'd likely brush off the weak job numbers as just noise or a welcome rebalancing, When asked about future cuts, he'd be vague and pivot right back to the inflation fight. In this scenario, there would be zero mention of liquidity or balance sheet support. The message would be clear. The Fed is willing to accept more economic pain to crush inflation. If we see a hold or even a cut with these hawkish signals, the market reaction would be fast and ugly. Stocks would drop, bond yields would spike, and risk assets everywhere would get sold off. Okay, so what does this mean for your money? The outcome of this meeting will likely set off a major rotation between different sectors. In a dovish rally, the big winners are the rate-sensitive sectors. Tech and other high-growth stocks would probably lead the way. These companies' valuations depend heavily on future profits, and lower interest rates make those future profits worth more today. You'd also expect consumer discretionary stocks, think hotels, restaurants, and cars, to do well as lower borrowing costs get people spending again. Real estate and home builders would also get a huge lift from the idea of lower mortgage rates. And don't forget small cap stocks. Many of them have debt with floating rates, so a drop in interest rates immediately helps their bottom line. On the other hand, in a hawkish sell-off, money would likely run for cover in defensive sectors. These are industries that don't depend as much on a strong economy. Think consumer staples, companies selling stuff you always need like food and soap, utilities and healthcare. These sectors are seen as safe havens when the market gets rocky. Financials like banks could be a mixed bag. The biggest losers in a hawkish scenario would be the exact same sectors that win in a dovish one: high growth tech, speculative assets, and small caps. This is one of the most balanced and high stakes Fed decisions we've seen in a while. The arguments for both sides are strong, and the market is coiled like a spring, ready to make a big move. So now I want to hear from you. What do you think is going to happen? Will the Fed deliver the dovish cut everyone expects, or will they shock the market with a hawkish stance? Let me know your prediction in the comments below. Cut, hold, or hawkish cut. And if you want my immediate breakdown of the decision and what it means for your portfolio, make sure you subscribe and hit the notification bell. I'll be going live right after the press conference to cover every detail. Plus, if you want to learn how I am going to profit on the decision tomorrow, feel free to sign up below in the link in the description and take my class called the Macro Investing Masterclass. You can take the entire first module free. All right, let's boil it all down. The market is hanging in the balance, and as we head into this week's announcement, you need to be ready for anything. Forget the noise and focus on the signals. Here is your final cheat sheet. For the dovish bullish case, you're watching for a 25 basis point rate cut, the statement mentioning softening labor and hinting at additional easing, the dot plot showing a median of 3 or more cuts for 2026, Powell focusing on job risks and hinting at liquidity support. For the hawkish bearish case, you're watching for a hold on rates, no cut, the statement emphasizing elevated inflation and a restrictive stance, the dot plot showing only 1 or 2 cuts for 2026, Powell focusing on the inflation fight and dismissing weak data as noise. The next 24 hours will set the market's tone heading into 2026. Stay sharp, watch these key indicators, and be ready to react, not just predict. This is a moment of maximum uncertainty, but if you know what to look for, you can turn that into a real advantage. Good luck and trade safe.